Welcome to the Pro Ticker Deep Dive.
Mhm.
So we're diving headfirst into, well, probably the central anxiety for everyone watching markets right now. Is crypto quietly setting up for its next big rally, or is this just another long pause before things head south again?
Yeah.
I mean, if you've been watching, you know we've been stuck.
Yeah.
Just completely range-bound for what feels like forever. It's pretty exhausting and, frankly, kind of boring.
That sideways grind, it definitely creates fatigue. But it's really important we look past the day-to-day noise. We need to examine the underlying forces.
Right.
So our mission today is to cut through all that sentiment, navigate the state of flux. You've got macro pressures, hints of institutional interest returning, those technical signals winding up, and give you a clear view, a distilled look at what the September data is actually suggesting is happening beneath the surface.
Okay, so let's start with the clear finding then. What's the main picture?
The main picture, based on this deep dive, is one of cautious optimism.
Cautious optimism.
Okay.
And the big signal for that.
It's stabilization, volatility, trading volumes. They've settled down, way down, historically low levels, actually.
That sounds quiet, which in finance can sometimes be the most unnerving sound, right?
Yeah.
What does this low volatility really signal for you, for the listener?
It's the sound of the market cleaning house, really. What it tells us is that the speculative froth, the quick money, the meme coin chasers, the excessive leverage, it seems to have finally faded. The market's become, well, maybe dense is the word, illiquid, because those short-term players have just left. And seeing this kind of resilience, especially with all the macro pressure we still have, that's actually constructive.
Constructive how?
It means the hands that are still in the game are likely patient. They're probably long-term holders.
But patience only pays off if the environment eventually turns favorable. So let's jump into that macro picture. Segment 1. It feels like very mixed signals globally.
It really is. We've got these persistent headwinds you just can't ignore. Inflation is still, well, it's still looming. And central banks, especially the Fed, spent September hammering home that higher for longer message on interest rates.
And higher for longer. Just remind us, what's the immediate drag that has on risk assets like crypto? Why do those high rates matter so much?
It's pretty basic, really, supply and demand for safety. When rates are near zero, money hunts for growth anywhere, right? Even in speculative assets like Bitcoin.
Sure.
But when the Fed keeps rates high, suddenly government bonds look attractive. Safe, even. You can get, 4 or 5% on a short-term treasury? Almost risk-free.
Guaranteed return.
Exactly.
Yeah.
So that raises the bar for crypto. Why take all that speculative risk if safety pays? High rates tend to suck liquidity out of speculative markets and funnel it into those safe havens.
Okay, that's the headwind, the big one.
Yeah.
But you mentioned tailwinds starting to push back.
Absolutely. That caution is being counterbalanced, slowly but surely. We're seeing signs of stabilization in the broader financial markets. There's this growing confidence, maybe, just maybe, we get a soft landing for the economy, not a hard crash. And we're seeing the bond market start to digest that possibility, repricing those long-term expectations.
Interesting.
But what's really fascinating and what you need to watch closely is global liquidity. Liquidity conditions are they're paramount for crypto.
Paramount how? More than stocks.
Historically, yeah. When global liquidity cycles turn positive, crypto often doesn't just follow, it leads. It moves ahead of broader markets. It acts like the ultimate canary in the coal mine for risk appetite.
So are we seeing signs that liquidity cycle's turning? Is the tide coming back in?
We're seeing precursors, let's call them that. Yield curves are flattening, real rates are stabilizing. Now, this doesn't mean liquidity is flooding back yet, but it's setting the stage. It's preparing the ground, creating this coiled environment.
And the big wild card here, always, is the U.S. dollar. A strong dollar usually punishes risk assets. What's the DXY telling us?
The dollar is still strong, no doubt, but the data suggests its recent, really aggressive momentum. It's showing signs of fatigue. It looks tired.
Okay.
Now, connect that to the bigger picture. More confidence in a soft landing, stabilizing bond markets. If the dollar starts to retreat, even a little, and global liquidity improves just marginally, that could be the spark, the catalyst crypto needs heading into Q4.
Okay, so the external picture is maybe slowly getting less hostile. Let's turn inward then, segment 2. Internal market health. Is the crypto ecosystem itself confirming these external hints, or is it still looking weak inside?
It's largely confirming them, actually, and it's showing this picture of quiet maturation. If you look past the price swings, the internal dynamics, they tell a story of structural repair.
How so?
Well, spot trading volumes, yeah, they flattened. They're not exciting anyone. But critically, they're not in free fall anymore. And maybe more importantly, market depth, that's the liquidity available on exchanges, it's stabilized too.
So what does that suggest?
It suggests patient accumulation. Sophisticated players may be buying quietly, replacing the panic selling we saw, last year.
Yeah, we see that reflected in Bitcoin's dominance. It's hovering around 50%, stubbornly high. Is that strength? Or is it fear keeping people huddled in BTC?
It's a bit of both, but I'd lean towards strength. It really mirrors the classic market cycle we've seen before.
Explain that cycle.
Capital consolidates first into the biggest, oldest, perceived, safest asset. In crypto, that's Bitcoin. Investors park funds there when they want exposure but are still nervous about risk.
Right.
Once Bitcoin establishes clear strength, builds a base, then confidence returns more broadly. And only then do you typically see capital start rotating out of BTC and into altcoins, chasing higher potential returns. Bitcoin has to lead.
Okay, that makes sense. Now, institutional engagement, always talked about, often overhyped. Are the big players genuinely coming back this time, or is it just noise?
It's more of a trickle than a flood right now, but it's meaningful because of where the activity is happening. We're seeing measured growth in futures open interest. And critically, that growth is concentrated on regulated venues, like the CME.
Ah, okay. Traditional finance players.
Exactly. That signals involvement from players who need regulatory certainty, standardized products. They're not just punting on volatile spot markets. They seem to be structuring longer-term positions. And on-chain data backs this up too. Long-term holders, these are wallets that historically buy when sentiment is low, when everyone else is panicking, they're consistently accumulating. They're net buyers in this price range.
Let's drill down on maybe the most critical internal metric, the one you call the aha moment, stablecoin flows.
Yeah.
What are they telling us about liquidity right now?
Yeah, this is, I think, a really crucial piece of the puzzle. For months and months, we saw the total stablecoin supply contracting, shrinking. That meant liquidity, dry powder, was actively leaving the crypto ecosystem.
Right, cashing out.
Precisely. But now,
Yeah.
that total supply is flattening out. The contraction has basically stopped.
Okay, so the bleeding has stopped. What does that signify?
It hints that the aggressive outflow is over. It marks the very early stage, potentially, of a reliquification phase.
So is this just money sitting on the sidelines waiting? Parking cash?
That's exactly what it looks like. Historically, this flattening or reversal in stablecoin supply, it's been a key precursor to major bull markets. It signals that the available dry powder has settled and is basically waiting to be deployed.
The market reloading.
Getting ready to reload, yeah. And quickly, let's not forget Ethereum here. ETH continues to show pretty remarkable structural strength. Staking activity keeps climbing steadily.
Regardless of price action.
Regardless of the current price action.
Yeah.
Total ETH staked just keeps going up. That signals real long-term investor confidence in the network's future utility.
That utility word is the perfect segue. Segment 3. The shift from just hype to actual utility. If this next cycle is different, maybe it's because of things like tokenization of real-world assets, RWAs. Seems like serious institutional interest there.
It really feels like the defining trend for this period, doesn't it? RWA tokenization moves blockchain beyond just, speculative coins or NFTs. It anchors it to core financial infrastructure.
How? What are we talking about?
We're talking about putting things like U.S. treasuries, corporate bonds, maybe even shares of real estate onto a blockchain.
Yeah.
Anchoring digital tokens to tangible, yield-generating assets.
But why does a big institution need blockchain for that? Can't they just use their existing systems?
They could, but tokenization promises radical efficiency gains. Think instant settlement, 247 markets, programmable compliance, fractional ownership of things that used to be really illiquid.
Okay, like making a corporate bond tradable globally, instantly.
Exactly, without needing layers of intermediaries. It's a huge potential shift because it changes the whole narrative. It's about efficiency, yield, infrastructure, not just speculation.
So how does this RWA trend potentially benefit the big two, Bitcoin and Ethereum?
Well, if global liquidity does improve, The RWA narrative could really boost Bitcoin's digital gold story, positioning it as this secure, decentralized settlement layer for high-value transfers.
And for Ethereum.
For Ethereum, the utility is even more direct. It seems perfectly positioned. You've got layer 2 solutions for handling the transaction volume, plus the staking infrastructure that institutions need to support these massive regulated RWA operations.
Okay, we need to stay balanced, though. That's the optimistic case, driven by utility. But the risks haven't vanished. What are the big hurdles still?
Absolutely. The main one, honestly, is still regulatory fragmentation. Globally, it's a mess, a patchwork of rules.
Yeah.
That uncertainty about market structure, custody, how assets are classified, it really clouds things for traditional finance firms. They need clarity, clear rules they can comply with. The lack of a unified framework, especially in the U.S., is still a major drag.
And the macro fears we talked about earlier, they haven't disappeared either.
Correct. Worries about economic slowdowns, especially in China or Europe, that could still trigger a big global risk-off move. That would hit all risk assets, no matter how healthy crypto looks internally.
Right.
And that brings us back to that technical warning. This low volatility environment, it's a trap.
Explain that volatility trap simply.
Think of it like watching paint dry, but you know there's a thunderstorm brewing just over the horizon. The low vol is compressing the market, like coiling a spring tighter and tighter.
Okay.
When markets get this quiet, this compressed, the move that eventually breaks the range tends to be sharp, violent even. That means sharp rallies or deep corrections can emerge incredibly quickly.
Which is why?
Which is why position sizing is absolutely critical right now.
All right.
Managing risk is paramount.
That brings us neatly to the technical view. Segment 4, that coiling pattern you mentioned. Given all these forces, the external pressures, the internal strengthening things, what are the charts actually telling us? Where might this break?
Bitcoin's chart is showing that classic compression pattern, almost textbook. It really does look like a spring coiling up. You see huge consensus, lots of volume, traded right around this current level.
Which means?
It tells us volatility is coming. A significant move is due. It doesn't necessarily tell us the direction yet, but the energy is building. Crucially, though, price is still holding above key long-term moving averages, which is generally constructive.
Okay, for someone trying to navigate this, maybe trading or just managing a position, what are the absolute key levels, the lines in the sand that define bull versus bear?
For the bulls, you need a decisive breakout, ideally on high volume, above that resistance area, around $70,000. That's the level that would likely unleash real momentum buying, signaling a clear uptrend.
And the downside.
The key is holding support near the $60,000 psychological level. If BTC fails to hold that, breaks below decisively. That could open the door to a much deeper retracement, testing lower supports. So staying above 60K is really important for confidence right now.
How does Ethereum look technically compared to Bitcoin?
Ethereum's actually showing some relative strength. It often holds up a bit better during dips, but it's still firmly range bound like Bitcoin. Its indicators, things like RSI and MACD, they're pointing towards a kind of neutral to slightly bullish bias.
Which fits with?
Which just fits perfectly with that quiet accumulation phase we talked about earlier. Patient hands, building positions.
And the key levels for ETH watchers.
Support looks pretty solid, down around $2,800. To get excited about upside momentum, you'd want to see a clear break and hold above $3,400. That would suggest capital rotation might finally be starting to warm up.
What about everything else? The altcoins? Any signals there?
Overwhelmingly mixed, still. You see little pockets of strength, sure, often in tokens tied to specific narratives like infrastructure or RWAs, but most alts are still lagging significantly.
So the old pattern holds.
It seems to be. Remember that historical sequence? Bitcoin needs to show sustained, verifiable strength first. Altcoin rallies usually follow. They don't lead the market out of a consolidation like this.
Okay, let's zoom out then. Pull all these threads together. For you listening, trying to position yourself in this weirdly quiet market, what's the core takeaway?
The main takeaway is that the market is, well, it's eerily calm. And that kind of calm, historically, often comes right before the biggest shifts.
Wow.
The foundational pieces seem to be quietly aligning. You've got potentially improving liquidity conditions globally, that trickle of institutional re-engagement, constructive technicals coiling up, and stabilizing internal health. It all points towards a potential inflection point.
But not guaranteed and maybe not immediate.
Exactly. It feels like a slow burn right now, not an imminent explosion.
So the overall message for you listening is probably patience. It's not just a virtue. It feels like a necessary strategy right now. Until this market breaks decisively out of this tight range, maybe just sitting tight is better than chasing ghosts.
Precisely. This consolidation phase, it could very well be the quiet before the storm for long-term investors. But, and this is the final thought we have to leave you with, the absolute highest priority in this compressed environment has got to be risk management.
Why emphasize that so strongly now?
Because in crypto, especially when it's this compressed position size, and actively managing your downside risk matter far more than having high conviction about the direction. Like we said with that volatility trap, these calm seas can turn into a violent storm almost instantly. Be prepared.
Sage advice. Manage your risk above all else. See you all in the next Pro Ticker Deep Dive.